Well, good afternoon. Welcome to our building products forecast webinar. We have just so many things that we're excited to take you through. And I think some of the details that you're going to see, we've been giving some of this detail to our research clients. There are pieces here that I do not think the industry has fully digested yet. So it's an important time. The market's shifting pretty rapidly. So let's get into this. Before we get into the meat of the forecast, some things that should be on your radar. First of all, if the type of content that we're going through today is useful at all to you, industry thesis, where the market's going, shifts in pricing, what's happening within products and channels, all of this, you should definitely be taking a look at our Building Product Outlook service. It's basically our subscription research service, and we curate all of our best ideas around home improvement and building products and all that part of the industry and give it to our researchers there. So it's a great tool, needs to be on your radar. If you want more information on any of these things, there's going to be a survey at the end of this webinar where you can please indicate if you're interested in any of those things, but also ask questions. If we're able to get to your questions, we will. If not, ask me a question in that survey, and we'll be sure to email you later on. A lot of our clients end up asking us questions that are really, really specific to their business. Help me understand this specific type of product, what's changing in adoption over time. Help me understand the features and different voice of customer issues that we're dealing with, or even those who are tied to the housing market, who do a lot of diligence around single family build for rent or lot and product segmentation. We have an entire advisory team that spends all of their time doing custom projects, custom research. If that's something you need, you'll have the opportunity at the end of this webinar to send them at least a reach out to be able to connect with you. You'll have that opportunity, so keep your eye out for that. And then we are excited to announce the latest release of Building Product Pro 3.0. All sorts of new powerful features that we don't think have been available to anyone before. But if you're focused on housing starts at all, especially at the locally geographic region, it's a super useful tool. Think of monitoring new starts by market, subdivision, builders. You can analyze builders and subdivision activity side by side, different builder profiles. You can, if you're interested in learning more about this detail, at the bottom right-hand corner of this page, you'll see the link. So zondahome.com/buildingproductpro. And then speaking of data, some clients are just hyper-focused on local housing markets. We have a whole number of markets that are boiled down. All these insights are boiled down already for these major markets. If you'd like to take a look at one of these markets for free, you can do that. Zondahome.com/market snapshot. And then just one last thing before we get into this. So if you've attended any of the Zonda events are excellently executed. And we have a new event that's going to be coming out in December, which I'm pretty excited about. We've had some clients that are really exploring the luxury space within the building product universe. Now, one of the things that we're going to touch on in today's webinar is that we think the thesis and the outlook is really different between price points of products. So remodeling spending, home improvement spending, even new construction spending among top income homeowners is really a very different thesis and story than some of the other parts of the market that are beginning to pivot right now. So to that end, we have an event, the Elevate event. Think of architects, CEOs, capital, anyone who's involved in high-rise luxury living. If you've heard the phrase luxury amenities arms race, you need to be at this event. If you haven't heard this phrase and you care about luxury at all, then you definitely should be there. So that's something new that would want to be on your radar. So let's get into the discussion for today. Our forecast. We just revised our forecast in a pretty meaningful way. You'll get the essence here. This is an unusual way to start a webinar, but this image, this is a tree in the middle of the road. I think it's a real tree in Iowa someplace. This was the cover image on our research report several months ago. And we think it really applies to what's happening in the industry right now. So we believe we see some risks that we didn't see before. We see them much more clearer. We also see the path around and what we believe is a really interesting growth trajectory afterwards, but we have to be sober about what's in front of our noses. So to start our discussion, could we show our poll, please? I'd like to get the pulse of everyone who's watching live. So I'm going to ask you two questions. Number one, please tell us what you expect U.S. building product revenue to do growth-wise in 2024. You can choose how much it's going to decline or grow by. And then also tell us what you think pricing will do for building products. There's a lot of debate about this next year in 2024. Is it going to decline? Explain the amount, or grow. And also think about, maybe as you do this, what's happening within inventories right now. All right. We'll just give you a moment to fill in those votes. Okay, so let's get into our discussion. So let me give you a sense of what we believe is right in front of our noses, and then we'll give you some of the details as to why. Big things are changing very rapidly. So this is how we're thinking about the next 24 months for building products. Right now, second half of 2023, all year we've been mentioning that we believe that risks culminate for building products. And that's the point that we're at right now. Interestingly, as I look at the results from this survey, the majority of those in this poll believe that the BP revenue is going to grow by 0 to 5%, so flat-ish. But there's also a large percentage, 25%, that think we're going to see declines, or perhaps even larger declines. And the general consensus is pretty much a bell curve on pricing. So 41% believe we're going to see like very modest pricing growth, but there's also a pretty fat tail that thinks we're going to see both significant increases or decreases beyond that 0 to 5% bandwidth. Really interesting. So let's compare this with what we see happening that we're seeing in our forecast. So as I said, major remodels right now, which we define as remodels that are over $25,000, are declining pretty significantly, we believe. Double-digit declines. We knew that was going to happen. It's happening right now, and I'll show you why. We also are seeing this unwind, and this is a really important point, unwind from what we call like middle America, middle income, 40th income to 60th income percentile consumers. That is, we believe, a reasonable amount of pull forward all happened among that group specifically. It's unwinding now. There's also a cycle time headwind, kind of over and above what's happening within housing starts, that's impacting the timing of the second half of this year revenue. Essentially, it's that we're seeing a normalizing of cycle time relative. It's still not normal, but it's closer to what normal would have been compared to 2022. And that changes the timing of when a lot of the revenue tied to new homes shows up. So that's a headwind that's hitting the BP companies right now. Looking into the first half of next year, we really see some things that are beginning to shift pretty rapidly. So multifamily starts are declining. Depending on what you believe is going to happen there, we see revenue front-loaded for multifamily. I'll talk about this more in the first half of next year, and then really declining rapidly in the second half. That's important. There's also much more risk, we believe, potentially happening around the CRE market. We're not calling for any type of systemic problem. That's not into this thesis, but we are astutely aware that if there's a problem, this is likely the window in front of the next few months in front of us as rates continue to get higher. And then we have to be aware that there's pretty big differences happening in the kind of the backlog of pro remodel book of business. So depending on the type of product that you're focused on, we're going to see really big changes between pricing environments, but also overall top line revenue. Then when we get into the second part of next year, we think we could see a pretty significant shift. And the timing on these things are going to be tricky, but we're confident on the overall shape of the story. So mortgage rates at some point we think will moderate. Part of that could be due to the spread versus the 10-year. It's hard to call the amount, but right now we kind of have that in mind in our thesis. We also think that there's this deferred backlog of pro remodels primarily concentrated among the top 20th income percentile. So that think like your kind of pseudo luxury customers. There's a whole lot of math behind this, but our sense is that that part of the market, especially interior projects, is underrated and postponed. More on that. And so we think luxury remodels will lead the growth. In the first half of 2025, we think we're going to see a lot of those postponed remodels come online, but not just remodels. You should think of potentially a surge in remodels, postponed moves, perhaps a rapid increase in existing home sales. I'll show you some math on this in a minute. And interestingly, we think the stage is set for the large amount of new HELOC accounts that have been set up to high credit score, high equity owning people who have not yet tapped that equity to be able to begin to tap that and fund incremental remodels. And this is going to happen at the same time as our pro remodel shortage is happening and continuing, which means that this channel battle that's happening right now between Home Depot and some of these other channels gets incrementally more hard and more heated. Looking forward beyond this, we believe that the kind of second half of this decade, 2025 to 2030, will likely be remembered for an elevated level of project activity, home improvement spending per household. This is a structural lift, more spending per household than anything we've seen, at least in the last 15 years. We have a whole lot of additional work that we've done on this that we haven't been able to fit into the report, but really what we're seeing is things happening in the data now that I have certainly not seen in my career that are unique, in some cases unusual outliers that are all happening at the same time. And I'm going to show you just one of them today. But the historical precedent, the last time we've seen this, we've looked at a couple different cycles where you dealt with inflation, was for postponement, and then double-digit growth. And I'm talking like 20% growth. We're not doing our forecast because that's what we saw before, but that's worth useful context to have. So some data points to keep in mind as we dive into what's in front of us. If you're not tracking the Zonda New Home Pending Sales Index, you should be. It's a really useful indicator of turning points within housing, and we think an indication of what's happening in kind of the underlying mobility rate for home improvement projects too. So the way I think about this number, this is Zonda's proprietary measure of what's likely to happen for new homes. This number continued to grow up until last spring, of course, when the rate hikes began. Then we saw 5 successive Fed rate hikes, 300 basis points higher, and we saw this new home pending sales index just crater, just fall until about this time last year. 2022 was a pretty rough decline. And we've had 6 more Fed rate hikes, another 225 basis points up. But the only channel that you could buy homes was among the builders, and you had an equity-rich customer that was buying a lot of move-up homes. And those are the same people that are doing some home improvement projects today. We've seen, genuine continued strength. Now, this is a seasonally adjusted number. Bear that in mind. The research that we sent to clients this week points out that the foot traffic that we've seen among shoppers at the builders has sequentially deteriorated from last month. So this month, the number that's on this page is 9/1. The data that we have from the middle and late of October shows sequential declines, still above what we saw at this time last year as a level, but the same general slope decline from October versus September. So we are watching that really closely in case we see things soften rapidly. But the story is that single family continues to grow because that's the only outlet. What you have to worry about next year for some of these building product companies is what's happening with multifamily. So 2 conclusions on this slide that you need to know. 1, we have not had this many multifamily units under construction in the history of the data unless you go back to the very early 1970s. And I know most of our discussion of the 1970s focuses on the late 70s because that's when inflation was happening and we were fighting inflation and raising rates. But it was the early 70s that had the big backlog in multifamily construction. And what we learned from that time, there's some really excellent data from the BEA looking at the broader industry output, the whole inputs, outputs, labor cost, everything. One of the things that we can learn by looking at construction costs at that time was when we saw this big backlog happen, that building products, materials, as a percentage of the overall output grew. They gained share, so about 200 basis points. And it held that level. So pricing was relatively strong for almost 10 years thereafter, even though we saw the multifamily backlog get worked through. So it's striking when we look at the current backlog at the far right, we have almost 1 million units in multifamily that are work in progress right now, started, that will be coming online into the market mid next year. They're going to be dollarizing in the first half of next year as multifamily building product orders. It's going to look great. Some building product manufacturers are going to bamboozle themselves into thinking that they're gaining share, when in fact it's just the lag installs from these products. And then it's going to shut off. It's going to shut off in the middle of the year. And we think multifamily starts are going to soften pretty rapidly. So the official starts forecast that we have that Ali shared, they do some excellent work on this, I believe was for minus 35% in multifamily starts for the entirety of 2024 versus 2023. Our head of multifamily advisory, Kimberly Byram, in our interview for some of our research clients recently, made the comment that she even worries about it being like minus 50% from a start standpoint. All of that would be loaded in the second half of next year. So you should be thinking about really volatile multifamily numbers. That's going to change how we digest that year. And then on the home improvement side, several things. So Matt's going to show you some numbers on input cost for contractors. We're always kind of sniffing around if pricing is holding. I want to show you an interesting data point that we use to gauge what's happening within contractor pricing. And it's very, very simple. We do ask contractors, what are your input costs? What are you passing along to consumers? And we report that. But I always kind of worry about whether or not contractors are able to accurately measure and track their input costs versus their output cost, or like how much they're actually able to monitor that in the survey. So as a supplement to that number, we also ask the percentage of the contracts that they're getting asked to bid on, the percentage of them that are immediately accepted, which is something you would have seen in like 2021. There's a pro labor shortage, there's supply, the product shortages. You just accept the first bid that you get, even if it's high, or whether or not they're getting pushed back across the table and renegotiated, which is an indication of price sensitivity. So here's what happened this year, and I think is really important coming into Q4. So in Q1, we saw a number of categories really have mixed results from a contractor pricing. We call this is the pushback ratio. Exterior categories was relatively strong. 47% of quoted projects from contractors in the exterior product category space were immediately accepted. We saw this number. We collected every month. It's reported here quarterly, but we collected every month. Every month, that number got worse and worse and worse. It was bad in January, and then it got worse in February, and even worse in March. And then Q2 happened, and we saw pricing stabilize and even improve incrementally. Exterior categories jumped to 55% immediate acceptance. Same thing for major remodels. Same thing for kitchen and bath remodels. Pricing across the board stabilized. And we saw that within the building products universe too. So why that's concerning and interesting is that we're beginning to see a decoupling happen, where certain categories like focus on the outside of the home, exterior categories, so thinking like cladding and windows and doors and some of the exterior yard space, we're seeing the cancel or this pushback ratio get notably weaker, drop to 29%. Now, we have not seen pricing weakening for the big project remodels yet. We think that's a lag. That's going to show up possibly in the next quarter, but we're watching it really, really closely. We think that's the first piece that's beginning to shift. Remember, big changes in the industry tend to show up as changes in prices first. So let's talk about what we changed about our forecast and what we're worried about. Why are we worried about? We basically brought down our full year forecast for 2024 by 6 percentage points for home improvement. That's a big deal. We think it's going to grow stronger thereafter, right? This is all deferral. But why is there this whipsaw going on? So there's some things that are unusual in the data that we don't normally see that we're seeing now. Here's one. So the University of Michigan publishes this number, which is really useful and underrated. That is the percentage of households. One of the questions that they ask households is whether or not households feel that it's a good time to buy big ticket durable household goods. So think like furniture or buying appliances. And what we have here is the difference in how the top income households answer that question minus how the bottom income households answer that question. So normally over time, you would expect the top income households who have more money, more purchasing power, to generally be more optimistic about buying big things for their home. And that makes sense. That's normally the case, except in 3 time periods where it was the opposite. So what a negative number means is the top income households were relatively more bearish than like the lower and maybe the middle income households on buying things for their home. It's a sign of an abnormality. It happened in the early 80s, the last time that we were fighting inflation. And then we went several decades until the financial crisis, and it briefly happened for several months during the financial crisis. And then it happened again right now for the last 24 months. It's a really big deal, where lower income households feel more optimistic about buying things in their home than higher income households. What's going on? This is a sign of something unusual that's going to unwind and change coming into 2024. Here's how we think about this. So we think that there's a shift that happened over the last 2 years that's beginning to reverse itself now. and it's going to be a pain as we work through it, but we'll get through it. So there's 85 million homeowners in general, owner-occupied households. Of those, if we were to divide those into income groups, the lowest 40th, 40% in income, which typically means anyone who's earning about $50,000, that only drives about 20% of the overall home improvement spending, primarily DIY, but they're being hurt right now. They're hurt the most by inflation. They're hurt the most by these real income declines. Their excess savings is being burnt off. We knew this was going to happen, and this was built into our model coming into this period. That's not new, but it's continuing to happen, and it will cascade into the home improvement numbers and DIY numbers we see over the next 2 quarters. What is new to us that we've learned in the last few months has to do with this middle band, these middle income householders, call it in the 40th income percentile, the 60th in percent. This is middle America. Think of anyone earning, say $50,000 to about $90,000 in income. What we think happened is if there's any pull forward in home improvement and spending, it happened among this group. And that is beginning to unwind now and will likely continue to soften, we think, through the first half of 2024. Then you have these top income households that, from what we can measure, has almost no pull forward at all. And we've tried very carefully to match this at the household level. And from what we can tell, right now, the slowdown that is happening almost entirely due to deferral. That this group under-indexed in how much they spent in a number of project categories. Most of the growth came from that middle income group, which I'll show you in a minute. So that top income group is the group that we believe is driving some of the incremental housing demand because they have home equity. But what's happening with the middle income group? Well, there's some pieces that are coming together that are important for you to know. And so let's start with what's happened with cash out refis. We have not talked about cash out refis in a long time. But how I think about the universe of cash out refis is if you divided the credit landscape into kind of these 4 natural clusters, the top 2, we know what these mean, but 800 plus means that you have an excellent credit score, you pay your bills, and you have a healthy balance sheet, and you can afford to take on additional debt. But if you're 740 plus, that's a healthy credit score too. Once you get below 740, they still might be okay credit scores, but there is more risk. Think of like the people kind of the lower lower 50% of them. Once you get below 740, the bottom 50% of credit scores tend to fall in that bucket, more or less. So why are we talking about this? Because if we go back to look at what happened for cash out refis that funded home improvement, from 05 to 06, of course, during the housing boom in the mid 2000s, what we saw happen was the mean credit score for cash out was around 680, which is in that lower bucket, and that's the midpoint. That means there's some that are even worse, that are stretched, and the average cash out was around 70K. There's a lot of home improvement that got funded, as well as other spending from that. Then for the following decade plus, we really saw the lenders tighten up for cash out HELOCs. And not just HELOCs, but cash out mortgages as well. The average cash out that's extracted, I'm generalizing over this time, there's more specific numbers over time, but there's roughly been between 50K and 70K over this time. But the credit box tightened, and we saw that remain tight up until about 2020 when the pandemic hit. What happened next? Are you aware of what happened over the last 12 months? So this is an important nugget to have in mind. When you think about 2022 to 2023, the average cash out value is around $100,000, right? At a time when it's pretty expensive to cash out, and the credit score has dropped back down. The mean is 715. Now that's not a horrific credit score, but it does kind of indicate that there is a group that's pulled out extra cash at a time when it's a little bit more expensive to service that cash, and maybe they have less pristine credit than the group did 5 years before. Why does this matter? Well, we saw this little gem that got published by the St. Louis Fed, raised a lot of eyebrows on our research team. So essentially what the St. Louis Fed raised their hand in mid-September and mentioned was that if we look at the default rates that's tied to credit card activity that's going on, usually credit scores were a great predictor of the likelihood that someone defaults on their credit cards over time. There's two pieces to credit scores. There's kind of their income and their balance sheet, whether or not they have the actual ability to pay the debt, or there's the behavioral aspect, whether or not they have a pattern of paying their bills on time or not. And so, basically what the St. Louis Fed flagged their research report here, which raised our eyes, is that if you take a population and you lock them down under COVID and you give them large stimulus payments, no surprise, they spend less and they pay their bills. And what happens when you spend less and you pay your bills is that your credit score improves. And so we have a large group of the population that their credit score has improved, but perhaps the actual credit risk associated with that credit score is not as positive as it normally would have been. I'll just highlight this point in red. Individuals with high credit scores in the post-COVID period are not as financially stable as those with the same pattern in credit scores in other periods, including those with improved credit scores after the Great Recession. So basically what we learn here is there is a group of people, we think it's some of the middle-income homeowners who have improved credit scores, maybe bought in homes, maybe done some home improvement projects that are credit funded. It could be by credit card, or in some cases, some home equity lines. Now, I don't want to give you the sense that we think any of this is systemic. We don't. There's not enough dollars extracted to make it systemic. But what it does do is it changes how we think about a very specific cohort of home improvement customers. So we did some analysis, a whole lot more detail I can share with this, but we just don't have time. Basically looking at, when the broader macro environment improved post-COVID, and you give households more money and you give them all the ingredients that they need to continue to spend, and we see them spend more on housing, you expect the broader market to grow. But what we learned was that once we control for the changes in the macro, the group that really surged the most, more than our models predicted that they should have surged, was this middle income cohort. So that's that 40th income to 60th income percentile. The math that we have shows that group spent 15% more. This isn't 15% more just versus what they did before. This is 15% more than our model suggests they should have, and this is inflation adjusted. So this is a big deal. This is excess spending. It's concentrated almost entirely among this middle income group. When we go to DIY, we do see it affecting a couple other groups too, but we see that drawing down right now. And so what we think is happening is basically we're seeing over the next 6 months that middle income unwind happening within home improvement. And so, by the way, the category that's most impacted by that is flooring. We have all that sensitivity published, but we're watching this pretty closely. Okay, so let's think about what happens once we get through kind of these immediate 3 to 6 months, and what happens from a more longer standpoint. We really believe, we've dug in this from a variety of angles, that when we look at how much home improvement spending has to happen, that we have a ways to go growth-wise over the next 7 years. We think that we're in a really interesting backdrop where people are in older homes at a time when they have to invest more in those homes. Their balance sheets are much stronger in general, apart from that middle income group, than they ever have been in the history of the data. And there's many other parts of the home that are wearing out. So we're tracking these things. We also think there's a structural shift that's happening that could give us the case where there's a kind of incremental, deferred, festering remodels, moves, or both. What do we mean? Well, the market doesn't always look at it this way. We think this is probably the right way to frame up moves and remodels. So if you think about owning and you think about moving, there's substitute goods. If you don't like your home, you can buy a different home, or you can remodel your home and maybe you'll like it a little bit more. And we see shows pop up on HGTV where they might buy a home that's not that great of a home, and then they fix it up and now it's a good home. So the thumb rule, we've done this over time. Here is the data on the homeowner move rate or remodel rate since 95. The thumb rule, just back of the envelope math, is that the typical household either moved or remodeled every 11 years on average. Okay, over time. It's been fairly consistent, but the mix of that has shifted. 2 decades ago, the mix was roughly 4 moves for every 1 major remodel. And by a remodel, I'm not talking about a small project. I'm talking about spending at least 25 grand in your home, enough to at least improve something about it. So it's got to be a meaningful purchase, but that's not that much. But what we've seen over time is as the housing inventory has gotten leaner and leaner and people move less and less, that mix has shifted more and more towards remodeling. It was 4 to 1 moves to remodels. It's almost at parity 1 to 1 today. It's 1.3 to 1. We think what's going to rebound, I have the number there in 2025, is a combination of moves as well as remodels. And we're already beginning to see this in some of the data. Just for context, the mobility rate has been declining for the last 70 years. Here's the data the last time we fought inflation, mobility slowdown occurred. This is postponed moves, and then we saw a surge as soon as rates moved down, just a fuzz. We've seen mobility continue to decline to about half of the level it was 40 years ago. And interestingly, no surprise, we're likely setting ourselves up for the lowest mobility number this year in 2023 than we've ever have seen in the history of the data. So why does this matter? It matters because what we're seeing now in some of the numbers from the New York Fed is a case for a big outlier swing in people finding either a different home or having to improve their home. So here's a really interesting data series. One of the questions that the New York Fed asks is, actually, this is mislabeled. This is not the census ACS data. This is the New York Fed data, which we'll relabel that in the deck that we send out. This is a really stable data series, as you see over time. It's the percentage of homeowners who tell us that they're planning on staying in their home only 2 years. So if you divide this by 2, this should tie to your move rate, and it does. Okay, why does this matter? Because here's the number for 2022 and 2023. So we've seen more than a 2x swing. That's more than 4 standard deviations versus the typical change from 2014 to 2021. We view this as pent-up future moves. People are stuck in their home. They're not happy. It's much more expensive for them to move because now rates have increased, and there's not that much inventory for them to find something else out. It's part of the reason that we think that the builders are having such good results, because they're the only channel that these movers can go to. And then we have this other issue going on, which maybe you've heard us talk about this before, but have you thought about the effect of record low inventory, of what this does? Planting the seeds for future moves in subsequent years or future remodels in subsequent years. So under COVID, we had no inventory. We remember this. This is a real image. I think it was from CNBC of homeowners waiting outside in New York, waiting to buy a home. You'd list your home on a Friday. You'd get 30 potential buyers walking through it, all submitting different offers. And on Sunday, you'd choose the one you like the most. And some of these offers were pretty shady in sense of the diligence, where these homeowners were waiving inspections. Maybe it wasn't quite in the right school district, but it was the home that was available, or it wasn't the right configuration and it had nasty interior, but this was the home they could buy. Well, now we're in this backdrop where you have a wave of recent home purchases, people who are stuck in these homes. They bought these homes basically under like time duress because it was the only home that was available. And from the data that we have, when we look at the satisfaction of the homeowners in those homes, they don't like them. So just the way I think about this, we calculate Net Promoter Score. We've done some primary research on this. It's an imperfect measure, but it's useful for comparing how much people like whatever product they have, including their home. So people have been in their home a long time, typically don't think their home is that great compared to newer homes. That's not a big surprise. Interestingly, though, people that have been in their homes between like 2 to 10 years like their home a lot more. Maybe they've moved in their home, they've chosen something that they like, but they've been able to improve it. They're also a little bit more likely to remodel because they're staying in their homes, and it's difficult to buy another home. Look at the read, though, for people who purchased their homes after 2020. That's a really low satisfaction rating. It's the same as people who've been in their home over 10 years. And it's not lost on us that the percentage of people that are planning on remodeling is also the highest among that group. That typically happens when people do move. But what we think is different this time is now that their options are limited. They just can't, that move versus remodel choice that they have to make, now their hands are tied. So we see this as, holding a beach ball underwater. You have people that are stuck in their homes. There's fewer homes that have been available for a long time. There's a subset of them that maybe have done a little bit of home improvement spending that is pulled forward. That's middle income. But apart from them, they are still unsatisfied in their homes, and they have to either find a different home or move or remodel or both. Add to that, we have some other changes that are happening within the pro contractor universe and the channel universe. And we have a recipe for some pretty big swings within building product revenue next year. And these are the type of swings that we think tend to be very long-legged, strategic. People who, companies that win market share changes over the next 18 months may have very sticky and market share gains, including pricing. What do we mean? Well, just to break things up, I've shown a lot of data at you. Maybe you can appreciate these. These are real contractor installs. You should know that. If you were to go on Reddit, you'd find images like this. But at left, we have a toilet that was installed in a new build. clearly not done by someone who's very competent. That toilet is sunk in the subfloor. If you ever have to call the plumber to replace that toilet, you will have to tear up the floor. So good luck with that. And then at right, this this is a supposed pro contractor install that I believe was referred to by one of the big box retailers. Make a mental note of that. And what you have here, now I'm not a pro contractor, but that exhaust vent, that is a way to poison your family very quickly by looping that exhaust vent. You're going to cause all sorts of issues. And I'm pretty sure that the fuel supply to this water heater, looking at the way it's curled around, I don't know if that's code or not, but that's definitely unusual. We have a pro contractor labor shortage, which is resulting in a quality issue among pro contractors. You need to take this seriously. And the reason that I'm flagging this, and I think this is an important theme, we don't know much in the forecasting universe definitively. What we do know is that the pro labor environment is going to get significantly harder. It's hard now. It's harder than it was 5 years ago. Buckle up. We see it getting incrementally harder just due to demographics and people leaving the workforce. And so when I saw this slide from Home Depot's Investor Day, I was really struck. And so let me just kind of walk you through the issues. So this year, Home Depot made the comment of what their sales outlook was going to look during market stability. They have a base case and an accelerated growth case. In their base case, they talk about investing in interconnected experience, so that's all digital, and then pro market share gains, and then opening some new stores. Okay, so pro market share is highlighted here. It's part of their strategy. What's in their accelerated growth case? Interestingly, we basically see M&A, and then let's do more pro market share. That's a very smart strategy for Home Depot to be focusing on. Our view is that the industry needs to take this pro market share battle very, very seriously. Make no question about it. Pro contractors is a finite resource that is going to get more and more finite and split between a larger number of projects if we see this wave of remodels happen going forward and new construction continue to improve. So why does this matter? It matters because we think we're seeing market share changes right now between channels among pro contractors. That's also leading to product swings and substitutions between the product brands. And Matt's going to talk about this more in a moment. But let me give you some numbers. So we think overall, if we break down the home improvement spending, there's roughly in the US about $375 billion that's spent by pro contractors. Of that, about $225 billion is product purchases that are made by pro contractors. So they have a lot of choice, and some consumers may be involved in that choice, but pro contractors have a tremendous amount of sway in what product gets selected. What's happening now is because we saw during COVID, such product shortages and these kind of shuffles around pro contractors shifting from their traditional channels to the big box retailers, and now they're going back. We're seeing this shuffling between year to year of which channels pro contractors are buying their product from. We think we're seeing about a $40 billion wiggle of products that would have been coming from one location going to another location. And basically, if you think about it this way, if you're a pro contractor and you're very loyal to one product or brand, you are now bumping into a new brand because you're going to a different channel. And even if you like your original product, there's a percentage of that 40 billion that's being threatened. And we think that percentage is 8 billion. We've done a lot of primary research on this. This is happening right now. Basically, pro contractors choosing a different brand than they did before, just as a byproduct of them shopping at a different channel. So this is just beginning to occur. And we think what's going to happen is a pretty big difference in top line and bottom line between some of the building product companies, but particularly the channels, as this begins to cascade. So Matt, I will go ahead and turn it over to you. Please continue to talk us through what you're seeing on the channel and brand side.
Great, thanks, Todd, and good afternoon, everyone. And I'm going to talk about the sales channel situation today and what we see is the setup going into 2024 in the next few slides. And the chart on the left here is from our Pro Contractor Trend Survey, which we run regularly, year-round, frequently. And the bars here are net penetration in purple, which is the percent of pro contractors that start using a channel minus the ones who stop. So it's the net difference. And then in blue, we have net loyalty, which is basically, again, a net score. It is the pros who say they purchased more in a given channel versus purchasing less. So first, hats off to the biggest winners. E-commerce and direct from manufacturer are growing on both the penetration and the loyalty fronts. While at the same time, hardware stores are unfortunately slipping on both. And if anything, we watch this closely throughout the year over multiple periods, and we've seen e-commerce's positive trajectory increase in hardware's negative trajectory also become more pronounced throughout the year. So next, let's inspect the pro channels. Lumberyards have been building upon loyalty all year and really shown themselves to be the darling of the established pro sales channels. But then pro dealers at the same time have slipped back a little bit. This is different than the beginning of the year. They were showing positive, like lumberyards, a little bit behind. But now we see pro dealers gaining customers at this point, but losing some share of wallet at the same time. So that's one we're going to keep a close eye on. And lastly, big box. Lowe's has actually added some pro customers this year, pretty impressive, while Depot is maintaining their roster. And again, penetration is just pros coming into the store. But unfortunately, at the same time, both of them are seeing some sales or share of wallet dilution. And Todd mentioned our tracking earlier of kind of proposals and how they are received. We call that the Zonda pushback ratio, similar to what he showed, some different math. And basically, the pushback ratio is the number of projects pushed back, not accepted initially for each project that is accepted right away. So on the left, we're looking at pushback ratio of 1, meaning 1 pushback for every 1 accepted. And then on the right, contractors who are experiencing 2 pushbacks for every 1 accepted. So clearly the one on the right is more, is more under duress right now. Sorry, having a bit of a system issue here. Todd, I'm losing the screen here. Okay, here we go. And so basically the higher levels of pushback, the 2s versus the 1s, are leading to a 6% increase in channel shifting, pretty significant. And then Todd spoke to a little bit of this as well, that the pushback ratios actually vary and change pretty significantly by project type. I won't belabor this since you got the concept of it earlier, but basically exterior improvement pushbacks have increased. That's a bad thing. That's more proposals getting pushback versus accepted, have increased to 2.3 over the year. And at the same time, major remodels are down to 1.4. So interesting differences we're seeing at the project level. And Todd talked about just the level of pressure that pros are facing going into 2024. It's pretty formidable, really. Costs are up, building materials plus 11%, and labor up 7%. And at the same time, backlogs are down 10 to 15%. So this is resulting in more pro contractors competing for fewer jobs, which just puts pressure on their pricing. And an 8% price increase is really quite good in a typical year. It's definitely not enough to stay ahead of their costs right now, as you can see on the low side of the scale on the left here. And we think this price cost gap is likely to increase for a while, for at least through the first half of next year. And the margin squeeze that we're Todd, is this you?
Yeah, I was just going to make a comment on this. So
yeah, go for it.
This chart always, you got to kind of take these numbers with a grain of salt, but this fascinates me because it's not so much the number, because we don't definitively know, contractors are not so good at creating like SKU level matching and like measuring elasticity and things like that. However, the message is pretty clear. Contractors know if their costs are rising more than their pricing in general. And they tend to be a pretty optimistic bunch when things are good. They also know when things are softening. So when we saw this, as well as the decline in backlog, This does feel like the backdrop of when you see, like you said, incremental channel shifts. Man, I know we hadn't prepared a slide on this, but just do you have any reflection on, that move in e-commerce was pretty notable that they reported. How much of that you think is give back from just like product availability versus before versus something that's more structural?
I definitely think there were some contractors fleeing to e-commerce, looking for lower costs. I would encourage anyone to go on to Amazon and Wayfair, and to see just how many products are out there right now. Never mind some of the kind of professional dealers that will sell to anyone online, including DIY. But I think there's definitely a lot more, because the other thing that we've measured, as you know, Todd, is that this margin squeeze that we're looking at here, this mismatch in the scale, is being felt, and you alluded to it earlier, being felt most by the smallest contractors. And that's a tough situation. They don't have the cost structure to readily cut back on. They also don't have the pricing power with their supply channels to command better discounts. And so they're really feeling a pinch right now. So sure, I think where they can trade to, potentially lower price, behind the wall type products, is probably helping e-commerce. And for all the economic information you just shared, Todd, I think we would expect that to accelerate next year.
Yeah, that's great.
So where do we see things going next year? On the left, we just have a reminder of the basics the pro contractors are looking for their sales channels. These are importance ratings. 5 is the highest, 1 is the lowest. And it's a pretty straightforward mantra that's really heard from the lumberyard to the Home Depot pro desk. So the question is, who's going to deliver on this in 2024? And here's what we're thinking. I'm going to reuse this chart from my first page just for illustration. And Todd, feel free to jump in at any point here. But we see no sign of e-commerce, when we just talk about some of the examples, and DFM letting up. They've had very strong growth. E-commerce, if anything, is really accelerating versus the beginning of the year, and also has plenty of runway as just more and more pros jump in versus some of the more established channels, like lumberyards, pro dealers, even big box that so many pros are already shopping at.
So what I'm
pro channels? Yeah, go ahead.
I'm just thinking, what thinking about what's happening this quarter, next quarter, the following quarter, arguably right behind like revenue and volumes and price. The question that we should be listening for is right around what they're seeing among their pro con, like who can actually explain if they're really executing and gaining share of pro contractors, and show a repeatable process in this environment where it's hard to retain and that pro contractor market share, market is shifting pretty rapidly.
Yeah, absolutely. And I think for those reasons, we expect the pro at Zonda, we expect the pro channels, really catering mostly or all to pros, lumberyards, pro dealers. We expect them to continue to do well. Pro dealers did well through most of the year. We had a little bit of slip later in the year, but where even though they're gaining customers, the purple bar, they're losing a little bit of their wallet through dilution. We expect both of these to be good stories next year, and with the primary reason that they really have the pro customer experience down. Looking at some of the factors on the left, some of these big boxes really hamstrung inventories, delivery, product variety that pro channels will just win every day. And so we expect them to continue to be strong, especially as times get a little tougher.
Yeah, let me ask you one more question for our listeners.
Yeah.
And listeners, I guess Matt didn't know I was going to ask him this question, but I think you need to hear his reaction. So we have this situation right now where the market's softening pretty rapidly. We have this middle income kind of unwind that's happening, and some of that's showing up as pro labor and DIY too. And as you mentioned, you're having this softening part of the market for some of these pro contractors. Looking forward, fast forwarding another, that 15 months, 24 months. Suppose we run into a situation where the market stabilizes and rebounds very rapidly. And what happens then among these channels? And let me plant this point too. Matt, I think back to a quote that showed up in our published research several months ago. I think it was in May, where a pro contractor had switched away from the big box retailers who they had gone to during COVID, and they went back to one of these kind of traditional pro channels. But then they said, I'm still checking the prices at Home Depot on the app every day. I see what they have in stock. I don't buy there, but I'm still looking. Does that pro, if the market tightens again, do they go back to the big box? Do they go to e-com? Like, what's your sense?
Yeah, great question. I think when we see the economy much stronger again and pros not facing these headwinds, that we're going to see them revert more to their comfort zone. And from experience, when business is great, the pros just don't spend that much time shopping around, and they're not going to spend as much time sending someone in a pickup truck to the store to pick up materials. They're just going to, kind of go full service with a group that they trust, and even bundle purchases as much as they can, one stop versus three stops. Today they'll do three stops because they need to try to maintain that margin and find a deal. And one of those stops might be e-commerce. So to me, that leads to the pro channels really bouncing back when times get really good for the pros again. I think they tend to be the preferred service model. They might not always have the best prices, and I think and kind of leads me to big box here. I think when times, if times get really tough before they get better, though, Todd, I think that's really going to benefit big box, just like big box was a safe haven during the pandemic. They are going to have favored nation status to get first inventory if supply chain blips again, as some experts are saying it's going to, that's going to get worse in 24. I think that'll really benefit big box. I think as things get better again, late 24, early 25 per your timeline, I would look to pro channels to really take off at that point. And when it comes to big box, we are seeing, as we've said before, Depot and Lowe's are just very well run and also continuously improving companies. We've seen some great staffing initiatives and others that they're doing. We've also seen some green shoots around, we're kind of showing you most numbers in the aggregate here, but we look at everything on a project level. Some projects, they are doing favorably well. We're seeing pros really go to them for certain projects. We're definitely seeing some green shoots going into 24. It remains to be seen sort of where they'll be on this kind of rack and stack list on the right chart here. Hardware stores, unfortunately, have just been on the bottom with pros all year. And one thesis we have is they might be getting caught between big box and agricultural retail, places like Tractor Supply. And they also rely on private label brands a lot, which we're seeing, lower cost doesn't always mean, more resilient when times get tough. Some brands kind of stand on their own. So the risk of shifting pro purchases is obviously, readily evident, to the sales channels. Shifting away, dilution, is going to hurt a channel. But as Todd showed right before my piece started here, it can be less obvious, yet still very large, with 40 billion in products at risk, he showed, at the brand level. And so when we combine the challenges that pros are facing leading into next year, fewer jobs, lower margins, especially with the smaller pros, and we add on top of that the increased level of channel shifting that we're seeing, we're going to see more and more brand dilution. And when I say brand dilution, it's just like channel dilution. If you notice that penetration bar versus the loyalty bar earlier, the penetration bar doesn't change that much, other than e-commerce, sort of a really up and coming channel. Channels don't get a whole lot of difference in the number of additional customers versus lost customers on an annual basis. people don't stop going there. They just go there less. They just spread out their purchases more on a job by job basis. And we've seen the same with brands. I don't think it was on Todd's chart earlier, but data we have looked at in that same study show that pros are using more brands. And so they're not necessarily leaving the ones they have, but they're diluting them, as they go to new channels. A channel might not carry the brand that they're used to. And many brands and categories, unfortunately, are substitutable to the pro, and they see the channel as more important even than the product in most cases, at least as our research has measured. So value brands, particularly private label that aren't available in multiple stores, and I don't really mean store brands so much like Lowe's Cobalt Tools. I'm not so much talking about that, but pure private label. They're particularly at risk. This is showing the percent of contractors who will switch very frequently based on the price point of the brand. And on the left, you're seeing that they will very readily switch out of value brands. And does this make sense? These brands are trading primarily on price. That's their message, versus actually really building a brand. And then moderately and higher price brands tend to be at less risk of switching. They're more sticky or more resilient, but I don't want to make it seem that much of a sort of a lump sum statement here. Show you some work we've done, kind of looking at different categories. So when we talk about stickiness, of course, that means the resilience of a brand, the tendency for pros to stay with that brand as times get tough, as their margins get squeezed, as they go to a different sales channel, and saying, nope, I'm not going to buy the siding you have. I'm going to make 2 stops today because I need to get my CertainTeed siding. So this is the Zonda brand stickiness metric, which we've shared with some of you in the past, and also dug into your brands and categories offline. This chart here represents a handful of brands from top categories. So we plot awareness against commitment, and of course you want to be in the top right quadrant. These are high awareness, high distribution level brands that even foster consumer pull through. Homeowners are asking for CertainTeed siding, OC insulation. They know these brands. So this is where you want to be, because as all of the channel noise is happening and all of the profit squeeze is happening, and you can think about these sort of brands in your own personal lives, cars, clothing, whatever you have heart for, you're going to stick to what you're going to stick to what you want and maybe make compromises elsewhere. Falling into the lower left, however, triggers some yellow lights, and really might even deserve manufacturer attention. And the interesting thing as we kind of unpack this new metric we developed more and more is the categories behave very differently. Vinyl siding, for example, you see CertainTeed in the upper right, right in the sweet spot, and then down in the lower left, where you don't really want to be, Georgia Pacific. Big difference based mostly on that commitment on the x-axis. And I don't have it highlighted here, but if you look at the top of the chart, maybe you can see my arrow. We have faucet brands, Moen, Delta, Kohler, very similar to one another. This indicates they all have really high awareness. They all have very high distribution, and their commitment is so close that they're going to be traded back and forth pretty readily with one another. So really the key is just understanding your category and how the pros engage with it, especially during challenging times. Todd, do you want to add anything on this slide?
I was just going to make the comment that in an environment where pricing is up in the air, this is a super useful way to think about the universe, because pull through, and especially pro pull through, is pricing power. So at the end of the day, when we think about how 2024 shakes out, and you've got this potential slowdown and then this potential bounce, which we're going to talk about next, this type of framework we think is going to get only more important. And we're looking at kind of by price point too. You get different distributions within some of the product categories. You could talk to us more. We don't have time to do that for all the product categories, but Matt, I'll go ahead to the next slide here just to wrap things up. So let's walk through a review, and I'll give you some forecast numbers here. So short term, what do we believe now that we didn't know before? Well, risks are incrementally increasing for building products. We're seeing the shift happen right now under our feet, likely culminating in Q4, which is where we're at. We think through the first half of 2024. I'll give you some forecast numbers here. Thank you for waiting to the end for this. We think building product revenue will be between 3 and 4% growth for new construction. That's built on a 9% starts decline. And the way I think about that is multifamily being down 35%, second half loaded in the year. You've got all this deferred backlog of spending from units that have started now that are dollarizing in the first 2 quarters of next year. Single family is going to drive growth. We have that growing. Ali just gave that forecast. What this means is that the dollar per start for building products, you get a little bit more squeeze there. We'll see increased product spending for start. And then also on the home improvement side, depending on your product category, we asked the question early in the year or early in this presentation of what people expected revenue to be. For home improvement, we're thinking 0 to 3% growth in dollar terms. But the story here is really, really different by price point and by quarter. So you should be thinking about significant year-over-year declines. We believe in the first half of 2024, we have double-digit declines for like the major big project remodels, and a meaningful rebound by Q4. Double-digit decline or increases, pretty substantial. And this breaks out enormously different by price point. Again, you can reach out to us for more detail there. But that's an important story. That leads into a really interesting 2025 structural shift underway. Think of project deferral leading to significantly higher demand for building products at a higher level per household than prior decades. I use the phrase holding a beach ball underwater. The strength in single-family construction, despite the rise in mortgage rates right now, is happening for a reason. That's the channel. That's the channel. So that's a sign of something more structural and important. So we should be thinking about a scenario where there's a rebound in mobility, a rebound in housing and major remodels, led by that high-income consumer group. And then one last point, this battle for pro contractors is absolutely underway now. That is the battleground between some of these channels. And as a consequence, the brands that play and go through those channels, we think this is a pretty interesting setup for pretty big changes and substitutions between some of these manufacturers and brands as a consequence. So our message to clients is don't be complacent. And now is the time to kind of dig deep and get closer to what's happening in the market. Thank you for attending. Please take the survey at the end. Continue. We get better. And if we didn't have time to do any Q&A, if you have any questions, please submit them in the survey, and I will be sure to reach back by means of email with additional details. Thank you for spending the time with us, and have a great afternoon.
Thank you.